Good afternoon, everyone, and thanks for joining us today for Manning and Napier's webinar discussing qualified plans for owner-only businesses. My name is Chris LaBounty, and I'm an advisor consultant at Manning and Napier, and I'll serve as your moderator today. As you can imagine, we're all working remotely, and we're doing our best to minimize disruptions, and we want to apologize in advance for any outside noise. We'd like to extend our well wishes to all of you listening. We're thinking of you and your families and hoping you're all staying safe from the coronavirus. Before we get started, I have a few housekeeping items. All call participants have been muted, but if you have any questions, and we hope you do, please submit them during and after the webinar using the box on the bottom right of your screen. When we conclude the presentation, we will spend our remaining time answering as many listener questions as we can. Additionally, we have a series of polling questions throughout the presentation. We're excited to be speaking with you today about how qualified plans for owner-only businesses represent a fast-growing opportunity for your advisory practice. And I'm going to introduce our speaker, James Esposito. He is a qualified plan consultant at Manning and Napier. In this role, he assists advisors, third-party administrators, and plan sponsors by providing retirement plan design expertise to better address plan goals and objectives. He's successfully helped advisors expand their book of business to include cash balance plan clients. James has also provided plan document and governance reviews to ensure overall compliance with an increasingly complex body of rules and regulations. He has also spent nearly 20 years working in the qualified plans arena, performing defined benefit and defined contribution plan administration and consulting. Before I turn it over to James, I'm going to just run through our agenda very quickly and then cover a few slides on the benefits of working with owner-only businesses. And so once I'm done with that, James is going to take us through defining what an owner-only business is, first of all, talk about different owner-only business types, help you identify net income and earned income, as well as define what that is. And then we'll talk through different qualified plan types and what situations they might be appropriate, as well as the owner contribution limits for 2021. And then James is going to take you through some of the data you need to acquire from clients and prospects to help you get started on the process of implementing one of these plans. And lastly, we will cover as many questions as I mentioned before as we can. And again, please continue to submit those as they come up during the presentation. So benefits of working with owner-only qualified plans. So I think, first of all, the lower compliance burden. So you could see here that until plan assets exceed $250,000, you're going to have some reduced IRS filing requirements. There are also no non-highly compensated employees, so there'll be no non-discrimination testing. You'll only talk with owners. So again, taking those participants and participant education out of the way is very important in reducing that overall compliance burden to you. Also, with the wide range of applicable plan types and design flexibility, you're going to see some reduced administrative costs overall here, which hopefully at the end of the day for your practice means a very scalable opportunity to add clients into these qualified plans. Next, I think that the problem that many of you may be facing right now and probably are on a year in and year out basis is that you have clients who are in decumulation phase and you have just general attrition in your practice. And so qualified plans for owner-only businesses solve that in a couple of ways. First and foremost, they're cash flow positive. These clients are obviously accumulating assets in these plans, and those contributions tend to be consistent every plan year. And in some cases, they may be required. So hopefully that helps you offset some of those spending rule outflows and general attrition that you might find in your business, and ultimately build a growing annuity for your practice. They also tend to be high retention, so very sticky business that hangs around. So that's always good, obviously, in any practice that's trying to grow or maintain their revenue streams over time. Next, substantive discussions that help win business. So effectively, you are helping these owners structure their income to maximize retirement savings and minimize taxes today. And so I think that places you in a great position to actually look very good for these clients, obviously, but also put you in a position for those money in motion events, whether it be rolling out of the plan, selling the business, or working on their other taxable assets. And lastly, there's a potential to earn referrals here. Obviously, if you're doing a really good job for a client, there's an opportunity to find other business opportunities. You basically position yourself as the expert in this space for your clients and prospects. And so just to summarize, I think the scalability, the cash flow positivity, the better positioning yourself for money in motion events, as well as the referral potential are all great reasons to consider working with owner-only businesses on qualified plans. And so now I'm going to turn it over to James, and he's going to take us through the rest of the agenda, and he's going to start by defining what an owner-only business is for you.
Thank you, Chris. Greetings, everyone. Thanks for joining us today. Well, what exactly is an owner-only business? It's any business that can sponsor what the IRS calls a one-participant plan, all right? And we've got some actual IRS words for you right here on the screen, but you don't have to read them, because basically what it means is owners, partners, and spouses only, all right? So if you've got an owner, just one single owner and no other employees, that's an owner-only business, and they can sponsor an owner-only plan. If you've got an owner and a spouse, same thing, that's an owner-only business. If you've got two owners or two partners and their two spouses, that's an owner-only business. Basically, what I'm trying to get at here is that owner-only or one participant plan doesn't necessarily mean only one participant. It can mean many participants, actually. There are over 26 million of them in the United States today. There's a lot to go around. And again, we refer to them, if you haven't gathered so far, we refer to them as owner-only businesses and owner-only plans. I think at this point, we actually have our first polling question, first survey question, Chris. So I shall return to you.
All right. So now that we've defined what an owner-only business is, how many owner-only clients do you work with currently in your practice? And so we've got a few options here. And we'll just wait a couple of seconds. I'm starting to see some results come in. And I think we can go ahead and post the live results now. All right, so we got a good group here. It seems to be pretty spread out, but it looks like the vast majority of you, 2/3 or so, have over 5 potential clients within your own book of business today that would qualify as an owner-only business. So that's interesting. And so I think I'll let James continue here through the rest of the video.
Thank you. So what sorts of retirement plans do owner-only businesses adopt? Well, pretty much the same types of plans that any other business will adopt. You've got your IRA-based plans and you've got your classic qualified plans. On the IRA-based side, it's the simplified employee pension. That's your Huckleberry, also known as the SEP. Okay, but that's a real bare bones arrangement, low cost, actually no cost. You don't really even need to hire any service providers when you do such a thing. But then on defined contribution, more of the qualified plans, defined contribution plans, that's basically a profit sharing, and 401k profit sharing. We'll get a little bit more specific about what that is in a second. But then also defined benefit plans. All right, we'll talk where and when. But what I mean here is your traditional average pay plans and your cash balance plans, and then also combination arrangements, 401k cash balance combos. You may have seen our content regarding those, profit sharing DB combination. Those are the sorts of things, just like any other business, that owner only situations will adopt. Oh, do I have a page issue? There we go. Now, what sorts of business structures do owner only businesses set up? Okay, again, pretty much the same kind of business structures that any business would set up. It gets down to 2 varieties, unincorporated or incorporated. Okay, so on the unincorporated side, that's also referred to as self-employed. You'll hear that buzzword quite a lot. You've got sole proprietorships and you've got partnerships, and you've got this beast called the limited liability company. Okay, the operative phrase there is limited liability, but you can have a limited liability company, a limited liability partnership, a professional limited liability company, PLLC, but all of those are basically names for the same thing. On the incorporated side, you basically got C corporations, your S corporations, and then again with the LLCs, they can elect to be taxed as a corporation. So, and can an LLP or a PLLC. So an LLC, we'll learn later, is a special beast. Now, what drives the choice of unincorporated versus incorporated? Well, it gets down to cost and complexity, essentially. But on the an unincorporated business, your sole proprietors and your partnerships are typically simpler and cheaper to set up and run. But the trade-off for that cost savings is the fact that the owner's personal assets can be attachable by a creditor. Okay, so for example, if I'm a bridge builder and my bridge fails, I may very well be the target of some angry folks looking to be made whole. In which case, my personal assets, if I'm unincorporated, may have to solve that problem. On the in the incorporated side, corporations are a little bit more complex and expensive to set up and run. But if you do it right, the owners can keep their personal assets away from the claims of creditors. Right. So you have two varieties, as I alluded to earlier in the incorporated setting. You have C corporations and S corporations. C corporations, you can sort of simplistically think of as larger concerns, all right? But the benefit of a C corporation is the unlimited number of shareholders, all right? That means you can sell stock to raise money like crazy with no limit, all right? But the trade-off, sort of a sub-trade-off to the C corporation, is that classic double taxation. You may have heard of that, but the corporation has to pay tax on earnings, and then earnings have to be distributed to shareholders as dividends, and the shareholders in turn have to pay tax. So contrast that with the S corporation. It's generally a smaller affair. There's a limit on the number of shareholders, and that's 100. So as you can see, it's not as easy to sell stock to raise money. But in return, the S corporation pays no tax. All of the income passes to the owner's personal tax returns. Okay. So far now you have two takeaways from what you've seen. All right. Takeaway number one, LLCs are a hybrid. They are less costly and complicated to set up and run than a corporation, and they default to taxation as either a sole proprietor or a partnership, depending on the ownership structure, all right? But they have the ability to elect to be taxed as a corporation, and generally when that happens, especially in the owner-only market, it's gonna be S-corp taxation that they elect, all right? And in an LLC, if it's done correctly, the owner's personal assets are safe. All right. And the second takeaway that you have thus far is that S corporations are special. Okay. Dividend tax rates are generally lower than income tax rates. So owners have a motivation to take their income as a dividend versus a salary. Also, payroll taxes don't apply to dividend income. However, because of a rule, owners can only use W-2 income for qualified plan purposes. We're going to discuss that a little bit today, and even more so in our next session. But keep in mind that most S-corp owners generally take at least some W-2 salary. Next in importance, alongside business structures, the types of businesses that owner-only affairs structure, an important concept to understand is the concept of net earned income. We're going to refer to it as NEI, net earned income. So what exactly is net earned income? Very simplistically, net earned income means income used for plan purposes. All right. And just like a square and a rhombus, all net earned income is income, but not all income is net earned income for qualified plan purposes. Other phrases that get bandied about for this concept are income, compensation, pay, but it's important to recognize that NEI, net earned income, is a function of the business types that we just discussed. Okay, now why do you need to understand NEI? Why do you need to understand NEI? Two reasons. Number one, qualified plan contributions are generally based on a percent of NEI. So in the simplest case, a profit sharing plan, 5% of pay is what everybody's going to get. If a participant's net earned income is $50,000, that participant's going to get 5% of 50,000 or $2,500 as an allocation. So there's one reason why you need to understand net earned income. The second reason you need to understand net earned income is that qualified plan regulatory limits are generally based on a percent of net earned income. So again, with profit sharing, the maximum deductible contribution to a profit sharing plan for an employer is 25% of eligible payroll. So if the total net earned income for all eligible participants is $200,000, then the most that's going into that profit sharing plan is 25% of that, or $50,000. Again, so that's another important reason to understand why net earned income, why you should understand net earned income. So, and I'll give you a third reason. If you understand net earned income, or at least the data that you need to collect to get the document the net earned income, you're going to differentiate yourself from virtually every other advisor on your block. I promise you. Okay. So how can you determine what your client's net earned income is? Well, in an incorporated situation, it's easy peasy. Net earned income is just W-2 salary. That's this little beast right here. That's the W-2. We've all seen them. We all get one. Maybe you don't. If you own your business, you might not take a W-2. In any event, it's usually box 1 on W-2. What else is this guy doing? It looks like we got a D and a DD. I am guessing that he made, or she, well, Tom T, taxpayer, made a $1,500 deferral to a qualified plan. It looks like $1,500 traditional deferral and $1,000 Roth deferral. Interesting. But in any event, that's incorporated. In an unincorporated situation, it's not easy peasy. It's hardy party. Okay, because net earned income is derived from net profit. All right, and it goes a little something like this. You start with the firm's gross income. All right, you subtract out expenses, utilities, the cost of doing business, that kind of thing, and that gives you the net profit. All right, then from the net profit you subtract the payroll taxes. In this case, it's half Social Security and 1/2 Medicare. And when you reduce the net profit by the payroll taxes, you are left with the earned income. Okay, and here's our example: $100,000 net profit. You see the Social Security and the Medicare tax amounts, and you see the earned income. The net earned income is the earned income reduced by a qualified plan contribution. So in this case, you see the contribution, $5,000. You subtract that off of the 92.9, and you're left with a net earned income of $87,935. Okay, but if you don't know the plan contribution, let's say you're trying to solve for the maximum plan contribution, you don't have the answer. You are in circular calculation world, and you need software to do that calculation for you. So what do? Well, for unincorporated situations, you focus on the net profit. All right, and we're going to give you some tools to handle that. But basically, that's IRS Form 1040 Schedule C, line 31. That's the beast right there for sole proprietors. And for partnerships, it's a different form, Form 1065, the partnership return, and Schedule K1. In the most recent iteration of the form, it looks like line 14 is the number that you need for each partner. So I think, however, though, we have arrived at our next polling question. So I'm going to turn it over to my good friend Chris for that question.
Yes. So now that we understand what net earned income is, what is the minimum net earned income required to benefit from a qualified retirement plan? I think we've got some results coming in now. I'll just give it another second here and make sure everybody gets a chance to answer. And I think that's just about it.
Okay.
What do we got? All right, 50% said all of the above. And I think Espo is going to talk a little bit more about the correct answer on these next few slides.
Okay, well, in my opinion, the answer is definitely all of the above. And perhaps the level of net earned income is a good way to determine which qualified plan type can achieve the objectives of particular owners in certain situations. So let's start with the simplified employee pension, the SEP, okay? And follow what I'm doing with the income ranges here, because they're not linear blocks, okay? In my experience, a SEP is appropriate for business owners of all ages. All right, the maximum deductible, or excuse me, the maximum allocation an owner will get in a SEP this year is $58,000. All right, you do need the compensation to support that, though. I think a good income range for SEPs is a net earned income of 120,000 up to projected annually. Because if you think about it, let's say you've got a sole proprietor with $120,000 net earned income. Notice I didn't say net profits, net earned income. And that person makes a $30,000 plan contribution. 120 after the plan contribution becomes 90 to live on. That's $90,000 that sole proprietor has left over for milk and postage stamps. So the SEP is a vehicle for, as I say, any age, but if it's a young business and a young owner and the income is low, you're likely not going to see them maxing out in a SEP, but they can do something. And in addition to the employer contribution, the owner can do a non-deductible IRA contribution. We'll talk to you about that in a second. All right. But as you inch up in income, okay, as net earned income increases, and here we're talking about profit sharing plans, and I put the range down there of $120,000 to $300,000. As net earned income increases, so does the sophistication of the business. So there might be more flexibility needed, and instead of an IRA-based plan, a classical qualified plan might be a better situation, especially if more flexibility is needed, like for loans, all right, multiple owners, if you're going to do different profit sharing amounts for each owner. Here's one. Maybe the owners are funding their buy-sell agreement with profit sharing plan assets, and you need a profit sharing plan to do that. You really don't want to do that in a SEP. So as the income increases, the profit sharing plan becomes sort of a more sophisticated, it's like the bicycle versus the tricycle. All right. The limits are the same, but the profit sharing plan has a little extra firepower for more sophisticated situations. Okay. Let's talk about the 401k. And notice that I lowered the income range here. All right. A 401k is a profit sharing plan, but in addition to employer money, the employee, so think of the owner as wearing two hats. The owner is the employer and is also the employee. All right. So the 401k profit sharing plan allows the owner, employer, to put profit sharing money in, but also allows the owner employee to voluntarily defer salary. And those limits are up to $19,500 this year. We'll show you that in a little bit. But you can use those salary deferrals. You can use them to leverage larger plan contributions, larger profit sharing contributions with a smaller W-2. All right, so this is perfect for S corporations. The 401k is perfect for S corporations that can balance their W-2 and additional dividend income to achieve the plan contributions they want to get. And as I say, you can leverage a smaller W-2 into larger plan allocations. You can use dividends, the company's dividends, for funding. So 401k in $100,000 to $3,000, I think, is a very flexible beast and has wide applicability. From those defined contribution types and IRA type plans, we're into deep defined benefit planning territory. And what I've done here is, well, let me put it this way. When the net earned income is consistently 200,000 plus annually, okay, this is where defined benefit plans are going to come into play for you. because the size contributions that you can get are much larger than the $58,000 defined contribution maximum. I mean, a person age 50 could easily get $100,000+ for a good long time, a good number of years into a defined benefit plan. But again, consistent net earned income, 200,000 plus projected annually. But when I say consistent, I don't just mean, future. I also mean past, solid, historical. And also another important thing to look for is years of service. So these businesses are going to be a little bit older. The owners are older. They've been around a little bit longer. They're a little bit more established, and their income is more consistently high. These are the businesses that are ready for that pension discussion. Doesn't matter if it's incorporated or unincorporated. And the same analogy can be drawn with the 401k plan. All right. If the income is high and consistent and they're not afraid, a single DB plan can often be the answer. But if there's some flexibility that's needed, maybe the owner says, yeah, I'm pretty sure I'm going to be making good money from here on out, but I want some flexibility in case something goes awry. Let's do a combo so that if something does go south in my business, I don't have to fund the 401k plan if I don't want to. I can just fund the cash balance, please. So that's where the cash balance combinations come in. But again, anytime a DB is in a defined benefit plan is in the picture, you really want to make sure that you have a solid historical, current, and projected future earned income. Okay, 200,000 plus is really what you're looking for there. Okay, bear with me 1 second. So, approximately how much can the client or prospect sitting in front of you contribute to a SEP, Simplified Employee Pension, or a profit sharing plan? Well, it's pretty straightforward. In an incorporated situation, the answer is easy, 25% of W-2. So if you're standing in front of a business owner and that business owner tells you, I pay myself a $50,000 W-2, I'm going to do it again this year, you can say to that business owner, a SEP or a profit sharing plan will get you a contribution of $12,500. And you can say it with confidence. Okay. What if it's unincorporated? And what if that owner tells you, I have a net profit of $50,000 this year? Well, your rule of thumb, remember I said to focus on net profit, don't use the 25, use 18.5 to 19% and give a range. Okay. But in no instance do you ever go above $58,000 for 2021. It'll be higher next year, but because that's the dollar limit. All right. But make sure you say also, give me some data, give me some documentation, and I will come back to you with a better number. What about 401k plans? Well, it's pretty much the same thing. Remember, the owner has the option to do salary deferrals and profit sharing. The salary deferral amount for 2021 is $19,500. The catch-up makes it $26,000. That's for folks over age 50. Okay, it's the same exact thing, except instead of $58,000, you subtract the salary deferrals off of that. So it's 25% of that W-2, but no greater than $58,000 minus the salary deferrals. So again, though, give me some documentation and I'll come back with a better number. Now, what about defined benefit plans? We've come up with a chart here, some rough multipliers for you based on ages 45, 50, and 55. Okay, assuming at least 5 years of service. So these multipliers are for that situation I described. You've got a prospect client, good consistent service and earnings history, good consistent current earnings, and good high consistent future earnings. And so all of that is in play here. An individual age 45 years old, if it's an incorporated situation, you know what their W-2 is, or they tell you, okay, you can basically estimate 49% of that could be funded into a pension for 18 years. So basically, if the earned income, if the W-2 is 100,000, well, we'll show you an example in a second. But these multipliers work. And if it's net profit, well, you just use the multipliers in this column. And we use net earned income in this next table here, but this is what it looks like for an individual with 5 years of service and an average net earned income of $230,000. I used average. I used that word intentionally because remember, it's not just current income that's important in DB plans. It's prior year's income and service and projected future. But 45-year-old with 5 years of service, $230,000 could fund $113,000 a year for 18 years into a pension. And you see the math there for the 50-year-old and 55-year-old. And also, I'm just going to back up one bit. These percentages, I don't know if you remember algebra, but they are linearly interpolatable. You can linearly interpolate. So if you've got a 47-year-old, if you know how to interpolate, then you can you can ratio out a percentage in between 49 and 78 based on that ratio of 47 to 45, and it's still going to work for you. We put it all on a chart for you, the DC stuff anyway, okay? Because we're givers. You can refer to it later. When you get the slides, you print the chart, you can keep it, you can pin it up on your fridge. We think it's handy. Don't forget the 401k, subtract out that 401k, but I think it's time for our third and final polling question, right, Chris?
That's correct. So what information would you need to recommend a qualified retirement plan to one of your owner-only business clients? All right, starting to see some good results come in. I'm just giving another couple of seconds here to make sure everybody's got a chance to answer. Starting to slow down. I think that's everybody. All right, pretty evenly distributed, a little bit weighted towards the age and NEI, but we'll probably hear more about that from Espo in just a minute.
Absolutely. I am looking at my clock just to gauge time here. I've got 4:33. I guess I'm talking too fast. Okay. If you understand these few things about your owner-only client, as I mentioned earlier, you're going to differentiate yourself from every other advisor in your area. All right. And I'm going to get to why that is in a second. But understanding your owner-only client means understanding these following things: age, business type, whether it's an S corp, LLC, LLC taxed as a partnership, LLC taxed as a corp, sole prop, all that stuff. Ownership percentages and partnership percentages if there's more than one owner. Okay. Current net earned income for defined contribution plans mostly, but also DB plans. Historical net earned income specifically for DB planning, and also projected future earnings, again, for not only for DB planning, but also to evaluate your prospect. Okay. If earnings are strong, that's somebody that you want to work with. Okay. Ultimately, it all boils down to data, gang. Don't fear the data. Right? The key to success in the owner-only market is developing a system that gets this data. And here's what I mean. Here's the data that you need to get. In an incorporated situation, the data you're looking for is IRS Form W-2. Okay. In an unincorporated situation, I showed you before, IRS Form 1040 with Schedule C. Okay. IRS Form 1065. Schedule K1 if it's a partnership, and then in either situation, you're going to need IRS 1040 form Schedule SE. Okay, if you can get most of those, as I say, you're distinguishing yourself. If you can get prior years compensation, that data, okay, get it, ask for it. If it's not available, keep it in the back of your head, but try to get it if you think it's going to be useful to you. All right. If you got a high earning situation or a consistent earner that you think DB planning will work, press for that prior year's information, because it may be possible to peg a benefit to prior year's compensation and then never have to look at compensation again. So, and that's some compelling planning. But essentially, what you say to a prospect is this, a client is this: to determine which or if a qualified plan is right for you, I'm going to need some data. And then you inquire: age, business type. You learn the net earned income picture. Business type, you learn the business structure picture. You get the income documentation. Maybe you can't get the income documentation, but maybe you can get it verbally. It's still okay. And then you say, thanks, I'll be back. And that's it. That's your first meeting. And never again will you ever have to say, well, we do things differently at XYZ, because you just did. That's your first meeting. You leave and you call us, and we will put together some numbers for you. So, Chris, I think you wanted me to take this slide, so I'm just going to keep going. What's the call to action? The call to action is go out and find some owner-only clients, okay? And definitely return to the next section, because we are going to profile various owner-only business situations, various ages, various business types and income structures. So we were thinking you could, learn about some owner-only clients in your situation, or meet some owner-only prospects, and then come back to the next section to see if any of the planning techniques we apply to our owner-only situations apply to your owner-only situation. So with that, I am going to turn it over to Chris and manage some questions.
Absolutely. Well, that's the end of our prepared remarks. So we're going to move on to some of the questions that you've submitted. But first, I just want a public service announcement. James mentioned that this is part 1 of a series. So we do hope you join us for part 2, A Life in the Day of an Owner-Only Business. And in the chat, you will see a link to register for that. So please do that now. And then you'll be included for that, and as well as have the opportunity to see the replay if you can't make it live. And you should receive an email from us in a couple of days with the replay of this part as well, if you're interested in that. But let's move on to questions. And like I said, we'll get as many as we can in within our allotted time. Continue to please submit them in the chat as we go. But the first question I have from the audience is there a max defined benefit contribution?
In a way, yes. But defined benefit plans are regulated in what can be paid out. Okay, whatever is required today to fund the promised liability to be paid out in the future is tax deductible today. So where that amount as a lump sum, that amount at say age 65 for a single individual with maximum compensation of 290,000 is, or 230,000, between 230 and 290 is going to be close to $2.5 million lump sum. Okay, so whatever is required today to accumulate under the actuarial, under the actuary's recommendations to that lump sum is a deductible. So only in the limit today is only insofar as what you're funding for, if that makes sense. Defined contribution plans are different. They're regulated on what goes in. Okay, those limits regulate what goes in. Defined benefit limits regulate what comes out. So whatever goes into a defined benefit plan to fund that liability is fully deductible. Hope that answers the question.
Okay, the next question is, let's see here. What other benefits might the owner-only market offer to advisors?
I think that advisors who are older and have built their firm and have younger advisors, or would like to fill the plates of younger advisors, I think the owner-only market is a great place for those advisors in training, so to speak, to cut their teeth and help grow the firm. It's a way for a young advisor to focus on a market that's pretty easy to work with, develop a prospecting system, and to, grow and get some early successes. These are small, I call them small bricks, like Chris, you were saying, cash flow positive. They're small bricks, but if you're building a wall, you want a wide base built with a lot of small bricks. You build your wall with big bricks, you lose a brick, you lose a wall. So starting a young advisor off by building off, getting some training and some great experience in this market, I think that's one great benefit.
Very good. What about an owner and a majority age child? Is that an owner only business when you have an adult child in the business as well?
Yes, that is. So ownership attributes to lineal descendants, up and down. So that from parents, that means grandparents, as well as children. So if you if father and son own a business, or rather, if father owns a business and son is employed and is over age 21 or whatever the age of majority is, then ownership attributes to the son, and that is considered an owner-only situation.
Very good. What about the tax situation? I mean, we've got a new administration, and then there's a lot of talk about the potential for an increase in taxes in general, and specifically around capital gains. How might these types of qualified plans play into that?
Well, that's a good question. In my mind, you never know where that's going to go. Things are proposed right now, and it we don't have anything final yet. So, and then of course, it's always you have to compare the capital gains rate to the marginal tax rate, not, so I think that qualified plans never hurt. And the jury is out. We just don't know the answer because we don't know what's going to get passed. How's that?
Good. How about trustee directed versus participant directed 401k? Does that decision impact the planning, either as a standalone or along with a kind of cash balance DB combo? Does that matter, or maybe you talk through that a little bit?
Well, I could see certainly an owner only, let's say you got 2 or 3 partners in a business. I could see why they might want to do a participant directed plan. And that's certainly possible. I think in most closely held situations where it's small, trustee directed will fit the bill. And it's generally the place they go first. And from there, they'll graduate up to participant directed if they feel they need a little bit more sophistication. So, owner only and trustee directed marries well together because, there's no participants, it's only owners, especially owner and spouse. Having one trustee directed account makes sense and saves expenses. So I hope that answers that question.
Okay, let me see if there's any last minute questions coming in here. All right, I think that's all the questions we have for today. Really appreciate you presenting for us today, James, and thank you everyone for listening. If we didn't get to your question, or for some reason you didn't get to ask it here, you can request to speak to someone here regarding this material or next week's, or any, again, follow-on questions. We'd be happy to do that. And you can request that in the survey that you're going to receive from us afterwards. As a reminder, for your convenience, we're going to have a recording in this webinar that will be emailed to you directly within the next several business days. But again, feel free to reach out to us at your leisure if you have any follow-up questions. Thanks again, everyone, for participating. We wish you well, health and happiness. Everyone be well, and take care.